Hello, everyone. Welcome to another edition of Tip Tuesday. Jeffrey Nance here with you. And today's topic is how to set realistic profit targets and stop loss levels. This actually aligns very well with a discussion we had last night during our stock and options watch and then our spreads watch, where we go and we look at stock trading opportunities and kind of consider some viable trading setups this week. And we talk about our profit targets and where we should stop out. Before we dive into the specifics of how to think through this, let's kind of talk a little bit about the process first. So, why is it important that we have a profit target? If we don't have a profit target, then we have no idea where we ought to be selling. So that does one of two things for us. It keeps us in a trade for just an infinite amount of time, because we're like, well, I don't know, I don't know when to sell, so I'm just going to hold it until I guess it feels right, or something. Or some people will have this like vague idea, oh, if it hits like $100 or whatever, and they bought it at 10, I'd sell there or something like that. But that basically turns you into a buy and holder because you have no idea when to sell. You definitely don't want to sell early, and lock in your profit. So you'd rather hold and end up with an expense. That's the mindset. It was just crazy, right? It's crazy that you'd rather hold and end up with an expense than you would to take profits at, say, $20 or $30, something like that, because the fear is that if I sell and it goes to 50, then that was just like awful, even though you would have made money. So you end up turning into a buying holder because you have no idea of what a proper target is. The other reason that profit targets are good is because they allow us to evaluate what we're doing with our understanding of technical analysis. So, in other words, when I look at a chart, do I understand what a normal movement would be on this particular stock in a given time period? Am I able to take my knowledge and then apply it directly to a particular stock? So I understand movement over time. If I don't have a target in mind, then I have no idea really how to evaluate that trade. Did I sell at the right time? Did I sell too late? Did I enter at the right time? What was the profit margin enough to really validate me entering that trade, or should I have passed on that one and done something else? So profit targets become very, very important. And then when it comes to stop losses, again, we're incorporating some of the same ideas there, that if we are entering at a good buy point, then that buy point should also serve as our stop out. So if we are indeed buying at support, and that's our trampoline, then unless our trampoline has a hole in it, all right, and we're willing to see how much further we're going to drop, then we should be stopping out when the stock basically breaks through our support level. All right, now that support level could be a support line that we've drawn, or many times it's going to be an exponential moving average. So it could be a horizontal price point from historically, like this line has really mattered. The professionals are definitely buying here. Historically, this line has mattered, or it could be an EMA, or again, as I mentioned, a support line. But there's something there that triggers an entry, and we go, that's a good time to get in this stock. And therefore, if it's a good time to get in, it should also be potentially, more than likely, a good time to get out, because that means that the trade isn't working the way that we had planned. Now, the question you would have at that point is, can I justify letting it get through this level because the next potential support level is close enough to let me see that before I get out? So in other words, there's a trampoline, but there's trampolines stacked on top of trampolines. Is that next trampoline close enough to let it break through this one to get to the next one? Now, that's what I call drawing a line in the sand. If you've been at the beach, then you know that you've got your blanket, your towel or whatever down there. And as the waves get closer and closer and closer, then you have to move your towel further away from the ocean, right? Or from, whatever you're at the lake or whatever, but normally an ocean's going to create your waves and stuff. So you move that line back, right? So our line in the sand keeps moving back as the current gets closer and closer to us. Well, the problem with that is and this is what happens to many students, especially when we're newer, is that we tend to just keep moving that line in the sand. And so the more we do that, the bigger our expense is. And we have a mantra here that we try to follow: win big, right? Lose little. And if you keep moving your line in the sand, you keep expanding your stop, then what ends up happening is now you maybe win okay, and then you lose big. And it's hard to keep up, hard to get ahead if you find yourself consistently losing bigger than you should have because you keep changing your line in the sand. So more often than not, I would say don't have a line in the sand, have a line in the concrete. When you put a line in the concrete, it's like there. It doesn't move. Like it's boom, there's your line. And so what you need to do is have the mentality to say, you know what, if this stock doesn't do what I expected it to do, perhaps I misread the technicals. Maybe I need some more coaching help. Maybe I need to go review my study materials, or just, maybe do my lines differently. That could be it, that I just drew them in the wrong place. But you need to have some way to evaluate what you're doing with your trade and then be able to stick to that. And so as we kind of move forward, keep in mind that that's what we're doing. So we're looking at it, we're going in here and we're focusing primarily on technical analysis at this point. So what is this stock doing based on what it is most likely to do next? Where should my stop out be? Where should my profit target be? So let's go out here and let's go look at some actual trade opportunities and kind of talk through this process here a little bit. And this should be a good discussion for us here. All right, so ACMR is one that we looked at last night. So let's go back to where it was last night. Tell you how we kind of thought through this. So this was a good setup for a bearish move down. I'm going to kind of zoom in here because I feel like it's too far. We don't need all that detail down there. All right, so what I really want to do is focus more on this. Let's just zoom in here. Let's do it this way. All right, and then I'm going to take you back to where we were last night because obviously things have already happened today. So we're going to have to go back. I'm going to have to refresh it here. It's not letting me go back. There we go. All right, so before we knew what today was going to bring, we talked about the possibility of the market being at resistance. Therefore, some bearish trades would be likely. So when you look at something like ACMR, you go, okay, well, what could this do? Well, it could drop from basically 14, and we start to look and say, okay, well, if it gets through this EMA, what's the next level? What's realistic? All right, so we could say, well, it's 1350, or we could say, well, really there's a lot more support. And by the way, we're going to look at the most recent moves for sure. They matter the most. But then we're going to look back historically too and say, well, is there anything back here that would really kind of solidify that area matters? And when we do that, we look at this, we go, okay, well, it's about $13. There's a lot of, that's the most recent pivot. So the stock was dropping. That's a big time candlestick there. It dropped and then it pivoted right here. So obviously I'm not going to, just totally ignore what's happened right here recently. So around, 1283, that's certainly an area we would watch. Now, as I scroll back over here to the left, I also look at this and say, well, there's some resistance back here. Look at this stuff right here, guys. It just didn't go past about $13 right there. And then you look over here to the right and you go, man, it just never got below about 1286 there. So that somewhere between 1280 and $13, like that's a realistic price point. This stock really could. Now you're thinking, Jeffrey, that's a $14 stock. Is it really going to drop that much down to $13? Well, yeah, absolutely it could. This week, certainly. Look at the range on today. That day right there, it was $1.36. So we're talking about, $1.30 move. Well, that's just basically the same move we got that day. And when you look at the R here, you kind of scroll through some of these days, $1.36, $1.06, $1.06, 98 cents, $1.38. So yeah, this stock, surprisingly enough, for a low dollar stock, actually makes some pretty big moves. So as you're preparing to enter that trade, you kind of think through, was that worth it for me to do a straight step two trade? Would I look at this as a credit spread? Or the best opportunity here would be, I'm going to do this as a debit spread. So obviously we're looking at this, trying to get into this. Now we're looking at it at night. So the problem is, if it does gap, then we're going to miss it. But still, this will be worth watching here. Guys, look at what happened today. So this thing opened this morning at 13.10 and hit a low of 12.95. Look at that. Isn't that crazy? Right? That's amazing. So now it had earnings. So we're going to ignore that trade. But see, even in the midst of earnings, you can look at this and go, wow, that thing makes a ton of sense. Like they didn't really like what they heard for some reason. Now they beat expectations. They were supposed to make 32. They made 57 and it still dropped. That's just why we don't like for you to trade during earnings, because they're so unpredictable. But look at that. I mean, if you hadn't known this was earnings and this had been a red candlestick instead, this is amazing, guys. So you've got your pivot point, $13. And this morning it opens at 13.10, goes down and hits a low of 12.95, and then it's already all the way back up to 14.28. That's so it closed at 15 yesterday, and it's already back up to 14.28, but it dropped all the way down to $13. So that's what you're looking to do with these things. Let's see if we can find a couple more out here that we might look at. So on something like AMD, this one is a little bit trickier because of the particular pattern that it's making. We really wanted it to come down, and if it would have come down more, we would have been able to do some very specific things with this pattern. Mainly look for it to come down here, hit this 5-day, and then go back up to the previous high. That would have been our expectation. So we would stop out at the 5-day. No need to let it get all the way down to 10. So let's talk a little bit about this. If this stock had dropped today and it was down here at around $109, I'd be expecting it to move back up to 112 this week. All right, so that's a $3 move. Where would I want to stop out? Well, the 5-day is at like 109.37. I would say stop out at this low right there. And that's basically 108. Now that's lower than you could go. But what I'm saying is, if you look over here to the left, you got a doji right there at that price. You got a high at that price. So, I mean, that's absolutely the price where you go, well, if it gets through that, it's headed all the way down here to 106.50 and maybe even lower. Why do you need to lose more money when the obvious stop out is clearly right here at 108, if not even higher at 109? If you stop out at 109, you lose a lot less money. So you want to define your stop out and then your expectations of what a realistic move would be. So let's look at another one we discussed last night, XP. All right. And the thought on XP was that it would do one of two things this week. So it would use these EMAs and go back up here to the 50-day. All right. So we would basically buy 21 and 22. That's our expectation, that the stock would move from 21 up to $22, or that if the market went negative, that this thing would actually drop from here back down to where? Well, 1950. Everybody see that? So that's your recent low. Now you might be looking at this going, Jeffrey, why would I go to the recent low when generally speaking, recently it's been in a downtrend making lower lows? Well, here's what I would say to you. Yes, it's making lower lows. All right. So you can look back historically and try to figure out where good pivot points might be. But look over here, like once it kind of went lower, it kind of stalled out right there and then started to make its way back up. Then it went lower, but still kind of stalled out at the same price point. Then it dropped and went lower. Then it moved back up, and then it dropped and went lower. Then it moved back up. Then it dropped and went lower. See, so that's what we would do. We'd be playing this down off of EMAs, anticipating a drop. Now, anticipating the drop, then that's where we would come in here, see if we could draw a good ray across there and say, okay, well, this was the last pivot up. That was the next pivot up. Let's see if it hits it there. And if we were to do that, I'm going to go ahead and just pop a line in here just so you guys can see what's happening here. So you go back in time and you would have a line that looked like that. And then once you drew that line in, you'd be looking to see, well, did it hit that line any other times? You would see it hits it right there and makes that move up. So now you would have a good support line, but you would either have to do some advanced stuff to try to figure out where that line would be, or wait till you've had a pivot or two and then know where your target would be on the way down. All right. Okay. Cool. All right. Let's do another one here. ON. All right, so here we are on ON. We're looking for this thing to drop. Now, we knew we needed negative market tone for that to happen. We don't really have that this morning. In fact, the market's still just floating. Not really committed to moving down, not really committed to moving up. It looks like one of those weeks where it's just going to be kind of frustrating, just floating. Now, that could be good for some credit spreads, those of you guys that trade that. If that's what ends up happening this week, we kind of get it where it just floats, then that's probably a week to do credit spreads. But what we said is, look, let's just look at this. Where's our recent low? 62.40. Where would we go? Well, from 68 down to 62.40. Now, we're going to need negative market tone, but that would be our expectation. So for this particular trade, we're going to stop out if it breaks past yesterday's high. No need to let it climb all the way up there, though you could try to decide whether or not you wanted to. You definitely don't want to see it get all the way up here. You definitely don't want to see it get all the way to 20-day, and certainly not fill the gap. There's no need for all that, right? So have a definite line in the concrete, decide what that would be, and then stick to it. And so on this trade, you're in it, and you're kind of going, I don't really like what it's doing today. It's not really dropping. But again, you knew you needed negative market tone. And if we don't get that, then this trade might not work the way that we want it to, but we could still go out there and say, well, this setup is really nice. Here's what it should be doing. Whether or not it does that depends on what we get with market tone, right? And then you get the same thing on something like this one, which is one that we liked last night. So you get your move up, you get your move down. You say, okay, where's my target price? $54. 54 would be your target on the way down, where we would expect that it could pivot there, start to move back up. Now, again, this is another one that's barely down, but again, we're still fighting market tone. They're just, for over a week now, we haven't had a single red candlestick on the S&P, as you can see. And as a result of that, look, we're on day 7 here. 1, 2, 3, 4, 5, 6, 7. 7 days of green candlesticks. So at some point you would think, all right, this thing they got to at least start to sell somewhere. Now, is it at this diagonal line? We'll see. But that's what's happening. So some of these really great trade setups that we had that were bearish trade setups, we're still kind of fighting market tone. And when you're fighting market tone, that's when you have to be even more committed to your stop out, because you know that you could be in a great pattern that may not work simply because the market tone is too overwhelming. All right, guys. So there we go. Appreciate you guys joining us today. Amanda said they still saw ACM. It should have been switching with me. You should have seen as I moved from one to next. So hopefully that was just maybe where you couldn't see the ticker symbol, but it should have been switching with me. You should have seen that. Hopefully that was the case, Amanda. I didn't see anybody else that said anything. So I hope that it kept up with me as it should have, so that you can see those other ones. And if not, you can go check those out. Because I've got the ticker symbols there for you. So you can go bring those up on your charts and see what we were showing you there, and either work back through this, listen to it in the background or whatnot. But appreciate you guys being with us today. Thank you for another opportunity. Good to hear. Right. All right. So that's good. Your screen froze. As long as ours didn't and it worked, that's what we want. So you can go back and catch this again, kind of go through those, or like I said, you can just add those into your charts, go back and look at those. So appreciate you guys joining us for another Tip Tuesday. Hope that this stuff helps you each week. I think today's lesson is a really solid one. It's also something that you'll probably just realize, I'm going to get better at this over time. I might not see some of these things, but hopefully this has simplified it enough for you to at least be thinking through the process of what's realistic. Because what we don't want to do is go back here, and I'll do this real quick because I want to do this. I want to make sure everybody understands something like this. What we want to avoid, guys, is you getting into a trade on something like Tesla, where you get into it down here and think, I'm going to buy Tesla at $200 and I expect it to go up to 270. So it's done that in the past. I think it's going to do that again. Now, would it be impossible for Tesla to go from 200 to 270? No, it is not impossible. But what you have to understand is if you think that's going to happen, there are multiple hurdles that Tesla is going to have to get over before it gets anywhere close to 270. So first off would be the EMAs on top, because now EMAs on top, they're going to act as resistance and push this thing back down. Then you've got gap lines, you've got gaps lines, you've got more EMAs, then you've got some horizontal price points. So just realize that 270 doesn't mean it won't ever get there, but your timeline is definitely going to have to be different, because you could be talking, I'm going to have to hold this stock for, 2 months, 3 months, 6 months, so it could realistically get back there if the market just keeps going up and doesn't drop again. Then maybe Tesla does recover in spite of their earnings outlook. Maybe they do recover and they get back there, or it could be, 4 months from now. So what you're wanting to do and what we're wanting you to do is look at a short-term scenario and understand that most of our trades, not all of them, but most of our trades are going to be anywhere from a couple of days to a couple of weeks. Well, it wouldn't be realistic to expect Tesla to go from 200 to 270 in a couple of days or a couple of weeks. That's not a realistic profit target. So what you would want to do in something like this, if you were buying back here, is to say, all right, is my target here, here, here at the gap line. You can see now it's clearly slammed on the brakes at that gap line. You see how it gapped down there? That was the opening price of that day. That has become resistance. So when you're looking and you're trying to figure out price targets, we also want to be realistic. Realistic means, when is this thing, how likely is it to happen? And then 2, how likely is it to happen within a given time frame? So you don't want to go into something and just go, oh, here's a price point, I think it'll hit this somewhere in the future. You need to have a plan that's a little bit more detailed than that. And that's the last thing I wanted to share with you. So wanted to add that in there before we quit today. So appreciate you guys being with us, and we'll see you next time.